Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing language of business filings to tell you what's really going on. And in this episode, we're diving into LegalZoom's latest quarterly report, but brace yourselves, because some of these numbers, well, they need a decoder ring too. Alright, so this is LegalZoom's report for the quarter ending June 30th, 2025. Think of it as a mid-year checkup on how the company is doing financially. It tells us about their sales, their expenses, and their overall health. We always want to see what's really happening behind the official statements, so let's get into it. First up, the balance sheet. This is like a snapshot of what the company owns and what it owes on a specific date. On June 30th, 2025, LegalZoom had about $217 million in cash. That's a healthy amount, showing they have money readily available. Now, accounts receivable. This is money owed to them by customers. It's around $23 million. What's interesting here is the allowance for credit losses, which is about $2.3 million for this period. This is essentially money they don't expect to collect, and it's good to see they are being realistic about it. And look at this. Goodwill has jumped from about $63 million at the end of 2024 to nearly $140 million, 140.25. Goodwill often shows up when a company buys another company for more than the value of its identifiable assets. This big jump signals a major acquisition, and we'll get to that later. Deferred revenue is around $214 million. This is money customers have paid in advance for services that LegalZoom hasn't provided yet. This is a great sign for subscription businesses like LegalZoom, as it means they have revenue guaranteed for the future. Now let's move to the income statement, which shows their performance over a period of time, their profit or loss. For the second quarter of 2025, LegalZoom had revenue of about $92 million in the same period last year. That's a solid 9% increase. However, their cost of making that revenue, their cost of revenue also went up to about $67 million from $63 million. This means their profit margin on each dollar of revenue is shrinking slightly. Their gross profit, which is revenue minus cost of revenue, was $125 million. This is better than last year's $114 million. So despite the rising costs, they are making more overall. But look at their operating expenses. Sales and marketing went up quite a bit, from $60 million last year to almost $70 million this quarter. That's a 16% jump. They are spending more to get customers. And general and administrative expenses also saw a big increase. They went from about $26 million to almost 39% increase. A big chunk of this rise is due to stock-based compensation. We'll talk more about that later. Because of these increased expenses, their income from operations actually slipped. They went from making a profit of about $1.1 million in the second quarter of 2024 to a loss of about $3.1 million in the same period of 2025. This is a key point to watch, and this carried down to the bottom line. A net loss of $266,000 this quarter, a swing from a net income of $1.3 million last year. It's not a huge loss, but it's a clear sign that costs are rising faster than revenue. Let's talk about some key numbers that drive their business. The number of business formations, which is like how many new businesses are being started through LegalZoom, went down slightly. They served about 134,000 last year. That's a small dip, but it's worth knowing, especially since the overall market for new businesses actually grew. And the total number of transactions also fell by 5%. This is partly due to a change in a government filing requirement that used to be a big source of their business. But here's a bright spot. The average order value per transaction went up by 12%. This means customers are spending more on average when they do a transaction with LegalZoom, which is good for revenue. Now, subscriptions are really important for LegalZoom. The number of subscription units, which are like individual subscriptions for services, jumped by 22% to over 1.9 million. This shows they are successfully getting more customers committed to their recurring services, which is a much more stable income stream. However, their average revenue per subscription unit, or APU, actually decreased by 6%. This means while they are getting more subscribers, those subscribers are on average paying less than before. This could be due to bundling services or offering lower priced options to get more people in the door. Their annual small business customer retention rate was about 59%. This means that out of every 100 small businesses that were customers a year ago, about 59 are still customers. This is a pretty important number for a subscription business. A higher retention rate means a stronger, more stable business. A 59% retention rate isn't terrible, but there's room for improvement. Remember those higher general and administrative expenses? A big driver was stock-based compensation. For the second quarter, it jumped from 18.9 million last year to 30.6 million this year. For the first 6 months, it went from 33.7 million to over 60 million this year. For the first 6 months, it went from 33.7 million to over 60 million. Company leaders and employees are getting a lot more stock awards, which is a common way to compensate and retain talent, but it does hit the company's expenses. Now, about that goodwill jump we saw earlier. In February 2025, LegalZoom bought a company called Formation Nation for $83.5 million. This company offers business services similar to LegalZoom. The goal is to grow faster, reach more customers, and offer more services. It's a significant move that will no doubt impact their future financials, and integration will be key. The acquisition also brought in about $17.3 million in intangible assets like customer relationships and technology. This is common in acquisitions, and it will be amortized over time, meaning it will be expensed over several years. On the debt side, things look pretty good. They have a revolving credit facility, which is like a line of credit for up to $150 million. But here's the important part. As of June 30th, they had no money borrowed against it. So they are operating without debt, which is a very strong financial position. The company also has a stock repurchase program. They bought back about 2.2 million shares of their own stock in the quarter, costing them about $20.4 million. This is a move often made to return value to shareholders or because management believes the stock is undervalued. Now, let's touch on taxes. They have unrecognized tax benefits of about $15.7 million, which is an increase from last year. This relates to tax positions they've taken that are uncertain and could potentially lead to a tax benefit if they are upheld. And when we look at stock options, they have a lot that are excluded from diluted earnings per share calculations because they are considered anti-dilutive. This includes over 10 million stock options and over 31 million restricted stock units or RSUs. This shows a significant amount of equity compensation is outstanding and could be converted into shares in the future. Alright, let's talk risks. LegalZoom is very clear. Their business heavily relies on new business formations. If fewer people start businesses, LegalZoom's primary customer engine slows down. They also mentioned that government actions and economic uncertainty, like inflation and interest rates, can hurt their business. This is a big dependency to keep in mind. Another major risk is getting those transaction customers to become loyal subscribers and keeping those subscribers happy and renewing. They saw a slowdown in subscription revenue growth recently, and if that continues, it could really hurt them. They acknowledge that managing their growth, especially after the Formation Nation acquisition, is a big challenge. If they can't handle this growth smoothly, it could mess with service quality and customer satisfaction. They admit their quarterly results can swing wildly, making it hard to predict what's coming next. This is due to a lot of factors, from the economy to how well their marketing campaigns perform to how quickly they can integrate their new acquisitions. They are essentially saying, expect the unexpected. And they're upfront about their past. They have an accumulated deficit, meaning they've lost money overall since they started. While they might be profitable in some periods, they can't guarantee they'll stay that way. This is a major red flag for any investor. Scroll, our business depends on our brand and reputation, which could be adversely affected by numerous factor ramifications. Their brand and reputation are crucial. Anything that damages that, like bad customer reviews or even just negative rumors online, can really hurt them. How they handle customer complaints is also a big deal for their image. They are also jumping on the AI bandwagon, incorporating generative AI into their services. This is exciting from a tech perspective, but they're very aware of the risks. If the AI messes up or gives bad advice, they could face legal trouble and brand damage. Scroll average order value kit. Looking back at the financials, that increase in average order value is good, but the slight dip in business formations and transactions coupled with that rise in marketing spend and the net loss in operations are concerning. It seems like they're spending more to acquire customers, and while they're getting more subscribers, those subscribers are paying a bit less on average. This isn't a terrible strategy, but it needs to translate into sustainable profitability. Operations and online services also rely on the continued functioning and accessibility of certain physical locations. They also have a concern about disruptions to their operations, whether it's from natural disasters or cyber attacks, especially with their reliance on cloud services and physical offices. It's a standard risk for most tech companies, but they highlight it due to their industry. And finally, they're always dealing with a web of laws and regulations. This is particularly tricky for a company involved in legal services. Any misstep in complying with these rules, especially around what's considered the practice of law, can bring serious trouble. Now let's talk about what this all means. LegalZoom is in a growth phase, clearly indicated by their acquisition of Formation Nation and their increased spending on sales and marketing. They're investing heavily in getting more customers into their subscription model, which is a smart long-term play for recurring revenue. The increase in subscription units is a positive trend, suggesting their strategy to retain customers and encourage deeper engagement is having some success. However, the rise in overall expenses, particularly sales and marketing, and the resulting slip into an operational loss and net loss this quarter, are signals that growth is coming at a cost. Their efforts to boost average order value are good, but the declining average revenue per subscriber suggests they need to focus on offering higher value subscription services to truly boost profitability. The past history of net losses also means that sustained profitability is still a goal they need to prove they can reach. The risks they highlight are very real for their business model. Competition is fierce, and relying heavily on business formations makes them vulnerable to economic cycles. Their brand reputation is also a significant asset, and any missteps, especially with AI or customer service, could be costly. Overall, LegalZoom is navigating a complex landscape. They are making big bets on growth through acquisitions and subscription models. The ability to manage their expenses, especially the rising acquisition costs and stock-based compensation, while also improving subscriber value and avoiding legal pitfalls, will be critical for their success. The increased goodwill from the acquisition means they've paid a premium, and demonstrating that this acquisition will deliver on its promises is key. They are not yet a consistently profitable company, and the market will be watching closely to see if this growth leads to sustainable profits. Alright, that's our breakdown of LegalZoom's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.